Company based in Cincinnati and Albertsons based in Boise. Let's try that one more time. On December 11th last year, Judge Adrian Nelson, appointed by President Biden, granted the administration's request for a preliminary injunction against a proposed merger between Kroger and Albertsons companies based in Boise, Idaho. We're going to talk a little bit about that today on Open Interest and take some of your questions. The FTC claimed the merger would result in a monopoly that would raise consumer prices. White House National Economic Council Deputy Director John Donnenberg said the Kroger-Albertsons merger would have been the biggest supermarket merger in history, raising grocery prices for consumers and lowering wages for workers. The companies subsequently terminated their merger agreement. Now, several politicians and, of course, the current administration have favored a narrative that the steep inflation that we've seen in grocery prices have been largely the result of price gouging. So, unsurprisingly, the administration targeted that deal and patted itself on the back when it came to naught. Now, the companies had originally announced that they were going to put themselves together back in 2022. Now that's obviously been terminated. The thing is that the revenue and income margin trends at these largest grocery chains, including Kroger and Albertsons, present a pretty different picture than the narrative of price gouging. So I figured one of the things I wanted to do, and by the way, I know we had some questions last week on MSTX and MFA Financial, which I do actually want to get to because I did have an opportunity to take a look at MFA Financial a little bit in the meantime. But let's just take a look first at the picture here. So Albertsons, and this is a stock that's obviously been very hard hit, as after the FTC had come out and said that they were going to try to block the deal, and then of course they got the court order to do so, and then the companies ended up terminating their deal. We can see that from 2022 onwards, as the likelihood of this deal going through diminished, that the stock has performed very badly. Now, what's interesting is that if we take a look at the financial performance for Albertsons, this is not a growth company, and this is not normally the kind of company that's on my radar because, as I have said many times, I like to see companies that are growing at least as fast as the economy. I like to see companies whose earnings are growing as fast or faster than that of the S&P. The logic on that being, why would we go out and try to pick stocks that can't even keep up with the broader index? And of course, that's kind of a simplification because the answer why we would be if they are trading cheaply enough. So let's just go back, and I can go back here. We'll take a look back about 8 years because that takes us back to 2016, which is the earliest year for which I have top-line data. Fiscal year ended end of February 2016. Albertsons had about $58.7 billion worth of revenue. As we can see, their net income was not actually positive at that time, negative free cash flow. More recently, so I'm just going to look out to the end of 2023. We're about, or 2024, excuse me. And then, soon you're going to get, obviously, the full picture for the 2025 fiscal year, which actually ends in February of this year. So it's actually coming right up. So revenues of about $79.2 billion. That represents about 35% growth in the top line over that entire period. And that may sound okay, 35% top line growth over the course of 8 years, but it's worth noting that the economy in the United States grew by about 55% over that same 8-year period. So top line revenues not quite keeping pace with GDP growth. Meanwhile, EPS, which, as I pointed out in 2016, they were actually coming off some net income losses at the time, about $2.60 a share for the full year ended February of last year. And the street's expectation is for something fairly comparable when they report fiscal 2025, which is really calendar 2024, about 227. So very modest, less than 1% EPS growth. Now, so the question we ought to ask ourselves at this point, so that still means that the company is trading at a single-digit price-to-earnings multiple. Now, what is also interesting is this bottom digit down here. And this was what was sort of catching my eye as I was thinking about this. So the company did about $786.5 million in free cash flow through the end of September. And the forecast right now is for $842.7 million in free cash flow for fiscal 2025. So that's going to be, reported, not this earnings report. And by the way, the company is going to be reporting earnings on Wednesday, but the next one we'll know what the full year numbers are. But that works out to, at the current valuation, that amounts to 7.4% free cash flow yield. That starts to get kind of interesting. Now, this is a situation where my guess is we haven't had great top-line growth. You're not going to get it. Grocers are a very mature business. You might look for better margins. The margins that they've been achieving, which have averaged, I was actually just looking at this last night, the margins have averaged about 1.6% since the end of 2019. They hit a zenith in the pandemic of about 2.6%. Politicians saying, oh, okay, so there's price gouging. In the first quarter of 2018, the net income margin was actually 2.8%. Now, these are not big numbers, and they're much smaller numbers than you might get at, say, a Costco. Right? So Costco's hardly a high-margin business either. It's a very narrow margin business. But here you're talking about 3% net income margins forecast, so almost double. Now, what occurs to me is that while this merger was in the works, it would make sense that Albertsons, which was being acquired by Kroger, would not be making huge strategic steps. Presumably, management from both companies were thinking about potential synergies, and presumably they believed that they were going to be able to boost net income margins at Albertsons, at the very least, up to the kinds of numbers that Kroger was seeing. So Kroger's margins, for what it's worth, about 2.2%. So that kind of a boost may not sound like much, 0.6% improvement in net income margins, but when your net income margin is only 1.6%, that's actually quite significant, because what you're actually talking about is boosting net income by about 37.5%. So why do I bring all of this up? My thinking is, now obviously it's unfortunate that deal didn't go through, at least for these two companies. Whether or not this is, harmful for employees, which Albertsons said it would be, or consumers, which politicians have said it would be, it remains to be seen. But it does occur to me that Albertsons now is essentially going to have to, follow their own path. And it does strike me that it presents a bit of an opportunity. Look, 7.4% free cash flow yield is far better than you're getting in almost anything else. And so my thinking is that there's a possibility here that management could actually embark on some strategic initiatives that could boost the company's prospects. This is not a business that is going to become a growth company. That's just not the way grocery businesses are going to work. Unless you're just a breakout new kind of theme. I wouldn't expect that. In theory, if people are going to remain healthy, they're not going to end up buying more groceries than you're going to see population growth. And then, of course, their footprint's going to make a little bit of an impact. But what is interesting also is that the options market's implying a move of about 4%, which is bigger than the 3% that the company has averaged over the last, several years. This data that I have goes back to 2020, and you can see if you look at the last 8 quarters, or even 10, there hasn't even been a 2% move. So my thinking here is that this might actually be an interesting place to get long the stock as sort of a speculative play. I'm not thinking of this as a complete value trap. Like I said, this is not the kind of name that I normally traffic in. But because it is trading at a single-digit earnings multiple, because there is room to materially improve profitability if they can just get their margins up to the area of some of their competitors, and because I believe that they've sort of hit the pause button for the last couple of years while they were waiting for this deal to take place, I think this one actually presents a little bit of an opportunity. And I think that the downside risk is fairly limited. Now, normally I like to obviously frame up an options trade, and I'm going to be happy to do that here. It has a 2.4% plus 2.5% dividend yield as it currently stands. So even just owning the stock is probably not a bad play. Two things got me looking at it. One of my former colleagues, who I think very highly of as a deep dive fundamental investor, and he started off on the high yield side. So, he definitely tries to keep his eye on risks. I've always said that I think credit investors are always looking for the cracks in the ice, while equity investors are usually looking for the upside. And this being the kind of company that it is, it's not really going to be on my radar most of the time. But he was looking at it, was kind of attracted by that high free cash flow yield. And Wells Fargo has an analyst that came out making some very positive remarks about it as well. And that his name escapes me, but I will share that with you in case you can find what he is looking at. So the Wells Fargo analyst is, where is this? Here we are. Edward Joseph Kelly Jr. And he is, as of last week, actually, he is ranking Albertsons as an overweight. He has a $23 price target on it. And for what it's worth, he is, in terms of the Bloomberg absolute return rank amongst analysts on Albertsons and a couple other names too, Walmart's, U.S. Foods, Performance Food Group. He's actually the Bloomberg analyst, #1 ranked analyst in the space. So he's got a $23 price target. He updated that last week. And this is a name I think you could conceivably own. I will also add one other thing. If you're interested in trying to be a little bit more creative about it, because of that 4% move, you could also consider doing something like a call spread risk reversal. If you use January, the stock doesn't go, the dividend is one of the reasons to own it. And the stock goes ex-div on the 27th. So regular way, and actually the weeklies immediately after will not capture the ex-dividend date. So you could use the January 17th expiration or the 24th expiration if you're going to do something like a call spread risk reversal. What might something like that look like? I'll just go out to the 24th. Again, trying to take advantage of the fact, look, these are not very expensive options, but this is not a very volatile space. But, if you wanted to do something like buy the 19.5s, sell the 20.5s, and then maybe sell a downside put, just look to suck a little bit of yield. When I was looking at this yesterday, this was like a 2%er in terms of what you could get out of it. That is to say that you were going to have at least 2% downside protection, which is more than the current quarterly dividend by a fairly substantial margin. That is definitely not going to be the one to look at. So these prices, it looks like, because I'm looking at stale prices, probably not that great. But this is probably the trade you would be looking to do. But, watch your prices, because right now, the closing prices, there's no real transparent bid ask on these. Yeah, there's no bid for the 18.5s. But those are options that should generally be, let me see what the price was right before the close, so we can take a look at what a reasonable bid-ask spread would be for these things. I would think that you want to you want to see these spreads like in the 15-20 cent range. Or you could just use the regular way. Let me just back that up and we'll see what that looks like. Same strikes. Yeah, that looks a little bit more reasonable. You're looking to get this thing off. When I was looking at this trade earlier, you could actually do this for even money. So you would get, call it 3.5-4% worth of upside and a buffer of a like amount to the downside where you wouldn't take any losses, have the stock put you at a lower level. If you did, that's fine. And then you're going to be collecting that dividend once you own it. And then if you start seeing any kind of a bid for volatility, you can sell some upside calls against it in between earnings. But this is going to be an interesting one. The management call on Wednesday, I think, should be interesting. In 7.4% free cash flow yield. Not super exciting, but sometimes that's okay. Sometimes we don't want excitement, and this is a decent place for that. Interestingly, one other quick point, the weighted average cost of capital for you, those of you who are using discounted cash flow models and things like that, is very low, as you would expect for these types of companies. It's like 6.4%. So another way to think about investments like this is, how quickly do I get my money back? And if you're paying 27 times plus for the S&P times earnings, and you're paying 8 times for this thing, you're getting repaid much more quickly. All right, so just one to get started with. MFA Financial. I'm trying to remember who had asked about that last week. One of you viewers was asking about MFA Financial, which is a REIT, invests in residential mortgages. And I mentioned on the January 1st live stream that it was trading at less than tangible book. And that kind of caught my attention, because obviously we like financials that are trading for less than tangible book. And I like REITs generally here, and I think somebody else is also asking that question. I'll throw that up there. Here. Yeah, so Ranjana Gupta. And Ranjana, were you the one that was asking me about MFA? I'm not sure. If you were, I had an opportunity to look at it a little bit more. And I was looking at one of these recent presentations, and let me see if I can find this section here. This is from an investor presentation that they made back in November, right here. So let's blow that up. I want you to see this. So the average coupon on all the loans that they acquired in the third quarter of 2024 was 9.4%. Very attractive, but also raised my eyebrows, because I was thinking to myself, well, how that, residential mortgages aren't paying 9.4%, nothing close. So the critical thing is, what other businesses are they in, and how do we feel about that? So they also, they have an origination business. They do some on the commercial side for things like home flipping, interestingly enough. And when I think about that kind of stuff, I think about hard money lending. And hard money lending, obviously, one would probably think of that as being a little bit more speculative than, primary, first lien mortgages, things like that. But I did have an opportunity earlier today to talk to a friend of mine who has a lot of colleagues who are actually engaged in that kind of lending. Now, they do it on more of sort of an ad hoc appointment-based basis. Most of them are former investment bankers. They create these pools, and they have hard money lending. And he was telling me that actually, that the risk level that they face on that type of lending is actually less than you might expect. And obviously, something like MFA is, a much larger organization. I don't know that it's reasonable for me to characterize it in the same way as this sort of private credit picture, but it is interesting, an interesting business, and apparently it is pretty well thought of and well organized. So, I think it's an interesting business, and I actually was going to recommend a different REIT. VICI Properties is the name. And actually, I'm probably going to talk about this one of these days on CNBC. Haven't yet. It's another REIT. And, they have, it's slightly different mechanism for business. It's not that they're investing in RMBS. And by the way, I should also add that at the beginning of last year, on CNBC, everybody has to come up with an acronym, and mine was BRAVE. The B was for Bitcoin. The R was actually for RMBS, which is what MFA is doing. So, it would be kind of unreasonable for me to, and I say RMBS as in the residential mortgage-backed securities business, not as in equity ticker RMBS, which is Rambus, which is something completely different. So, yeah, I do like the business. That's the short version. It looks like they are investing in some fairly creative stuff, and so I like MFA, and I like REITs for that reason. I also want to make one other point, which is that, we often, whether it's on CNBC or whether it's on this live stream, I'm just taking questions, and so we're, answering things sort of in an ad hoc fashion. That's very different than constructing a portfolio. I like REITs as one of the core constituents of a portfolio because you're going to be getting those distributions, and depending on the nature and use of your portfolio, if a portion of it, and for many people it is, and if it isn't now, it soon will be, their principal source of income, then you do want to be getting, distributions from that. And REITs can be very attractive for that purpose, largely because they tend to maintain, fairly good risk characteristics, very high distributions, and favorable tax situation. And those two things, of course, run hand in hand. Okay, so there was one other question that I think came up, and I'm not sure that I answered it. I don't see it here. If whoever was asking wants to, it was about MSTX. MSTX is the levered MicroStrategy ETF, and I realize these things are all the rage these days. The question was, this is a 2x levered MicroStrategy ETF. I don't like these strategies in general as a long-term investment. And the reason I don't is because they tend to have a lot of decay. And so while instantaneously their performance may indeed be what's written on the tin, which is that you're going to get 2x the returns of the underlying, it does not work out that way in the long run. And that's going to be more true in a situation like this. And the reason for that is because MicroStrategy is a very high volatility instrument. So the options, which is how these guys get their leverage, and the reason they have to use options to get their leverage is because these are exchange traded funds. They can take leverage, but they can't do it simply by margining the stock. And the reason they can't do that is because the fund cannot be at risk of turning negative. And they cannot call upon equity investors for capital contributions should they need them. So consequently, they have to use options. Decay really plays into it. And if you take a look at the performance since this thing was issued back in August, you're going to see what the downside of that is. So there we go. So this line here, this is MicroStrategy, and you can see it's obviously off of its all-time highs, but nowhere near as far off of its all-time highs as MSTX, the 2x levered ETF is. If you want leverage using options on MicroStrategy, trade the options on MicroStrategy. Don't pay somebody else to do it on your behalf, and you don't have quite the same transparency. And don't forget that MicroStrategy itself is a levered play on Bitcoin because they're borrowing money to buy Bitcoin. So, I still like Bitcoin. I obviously liked it at the beginning of last year. As the name acronym BRAVE indicated, the B was the very first thing I mentioned was Bitcoin. This year, I'm also going to say that if you hold it, you should continue to, and if you don't, you could, maybe use IBIT to get long. But this is a cautionary tale for why you want to be careful using levered ETFs as a long-term play. I don't like that as a strategy. I don't recommend it. If you're using it as a trading vehicle, that's fine. And by the way, it should be mentioned that these are typically used as a trading vehicle by people who cannot otherwise trade options on the underlying. So as a simple trading thing, fine. Otherwise, yeah, no, I don't like it. Okay, not as a long-term hold anyway. So, hi Mike, I'm thinking of hedging my overall portfolio with long 20 delta puts on SPX NDX 2 years out. They don't seem too expensive. Any thoughts? Well, okay. So they aren't. First of all, vol has come in. It's not hugely expensive. The VIX index is only looking at 30 days. But if we take a look at the term structure of the VIX, we can take a look at longer dated futures and get a picture of what those are. And we can also see the shape of the term structure, not wild. This is only going out to September 2025. Let me just look at the curve. I probably didn't set this to go out that far, but not wildly expensive. So I think that's fine. There is something else going on here, which is that, and I pointed this out in other contexts. I think it was in the context of collaring up an NVIDIA position. And that is that as interest rates rise, all else equal, the value of calls rise and the value of puts fall. It's a carry cost thing. You know, we don't need to get completely into the weeds about that. But basically, as the forward price goes up, and the forward price will go up as a function of interest rates, the value of calls rises and the value of puts falls. And so a combination of low implied volatility and higher interest rates means that downside puts on any underlying instrument are going to be less expensive, all else equal. So they are quite reasonably priced. So let's take a look at how reasonably priced they are. And we'll use SPX first. And, you know, I'm going to use the live markets. I have a little modeling tool here that just prices it off of the vol surface, but might as well just pick something that's actually listed and use that as a guidepost. So 2 years, December 2027, or you went January 2027. So that's I'm going out a little too far here. I'm sure I have that. So let's just find that January. Where is it? Probably looking right past it. You know what? I'm just going to go to December of 26. They're not going to be that much different. So the 20 delta puts on SPX would be, well, it looks like they're going to be 5,300-ish. Let's see. $5,000s actually. So 5,000 strike puts, pretty far out of the money. $17,500 per contract. Or just under 3% of the current price of the underlying. Yeah, I mean that's fine. 20 vol for those. The only issue that I have is that if you go that far out in time, these are not going to have that much convexity. They don't have that much gamma. And so, you know, that 20 delta is really what you're going to get. I mean, think about this. So with the S&P at 6,000, the 5,500s are 24 delta, and the 5,000s are, you know, or 5,250s or whatever, 20. I might go a little nearer dated than that, just so that you get a little bit more bang for your buck. I'll admit, you know, for myself, I don't usually buy really long dated protection like that. Number one, because it's more tactical in nature. So I'm more likely to trade nearer dated strangles and hedge them. And then hope that the gamma will kick in. And it usually does, right? Because what happens is if the market falls, you get that gamma pop. So even if you're delta neutral, it gets you shorter as the market falls. So like on that big swoon day, and that was the day I admitted I hadn't actually been paying that close attention. And, you know, the hedges worked out very nicely that day. But also as a function of the vol pop. So when the VIX spikes, they have more reactivity to that. The longer dated implied volatilities aren't going to move quite as much. So you don't get the benefit of the gamma, and you don't get the benefit of a big move in implied volatility because it's not that likely to occur. You know, but the flip side is you're not going to be paying much theta. So if it makes you sleep if it helps you sleep at night, that's fine. But it's it's sort of a set it and forget it approach. And the other thing is, you're talking about, 52, 50, it's down in that neighborhood. Those are the kinds of deltas that you're talking about, that 20 delta option. So, if you're just thinking in your mind, okay, so I'm protecting myself below that level. You're firmly into correction territory before those things are in the money. And if you were buying 20, 25 delta puts and calls near dated, say 45 days out, those are going to be tight. In fact, actually, rather than just talk about it generally, let's get specific here. I'll just go out to February 21st so we can take a look, regular expiration, at what the cost of something like that would be. So oops, I forgot to adjust that back. To the monies here. So, for very relatively small amounts of money, you're going to be, buying, let's say I bought a 30 delta put, this thing is going to get a lot of action. It's only 100 points, 120 points out, right? So this is really pretty close. And, the upside call that we would be dealing with, so I should probably just go to the money here. Yeah, so I'm going to go up a little further. So you're going to be looking at, the 6,200, 5,800, 6,200, something like that, strangle. And that whole package is going to cost you less than 10 grand per SPX strangle neutral. And if we get another, 2%, 2.5% day, this is definitely going to play. And you can hedge your gamma in the meantime. You're still going to bleed hedging your gamma because the market doesn't typically trade to, 12, 13, 14 vol. It's probably trading closer to 7. So even if you're hedging it, you're going to recapture some of that. And you can do that however often you want. Somebody was asking me, hedge it once a day. I usually would probably hedge it twice, like that. But that's the way I would prefer to play it. But also remember, you're going to have a lot of stuff in your portfolio that you're trying to be active around. And if you get really long dated S&P puts, that might work for your strategy. But if you're trading other stuff around, you probably want to be a little bit more dynamic. Joseph Kamen, Happy New Year, Mike. Happy New Year to all of you guys. For anybody who didn't join us on New Year's Day while I was in Bend, Oregon. Here's to another great year, 2025. Will U.S. Steel survive? Yeah, well, this is interesting. So we had the Nippon Steel acquisition deal. The administration decided they were going to go after that. They're going to fight back, as it turns out. So I think this is kind of an interesting situation. We do have a new administration coming in. Kind of interesting to me, actually, in the context of the Kroger-Albertsons deal, that they just sort of terminated the deal on the back of that court ruling. Maybe they could have, because it was an injunction, so they could have presumably, tried to slog it out a little bit longer. Decided not to. But they are trying to fight it. One thing I will say, and that is that I think that the political climate for trying to preserve manufacturing jobs in the United States is a good one. So that is a potential tailwind. I don't think anybody wants to see this whole thing fall apart. And our steel industry really hasn't been that competitive in a while. We had issues with Chinese dumping and so on, but the company's still got about $1.8 billion of cash on the balance sheet. That's going to buy them, and they actually weren't expecting really big negative. So the last couple of years, they've had really serious negative free cash flow, over $1 billion. Well, that was not the forecast for this coming year, for this year we're in, I should say, for 2025. So consequently, I actually think that it's probably, it's probably worth a look. Now, actually, today really caught a bid, partially on the news that they're going to fight this. But you can own this thing at a significant discount to even where the stock was trading about a year ago. Oh, yep. Somebody just pointed out that I had quote media on my screens. That was something else I was looking at earlier today out of curiosity. So here's U.S. Steel. I think they have sufficient cash, a friendly administration coming in. It's a tough business, though. Obviously, we've tried to salvage and make the U.S. steel and the aluminum business too competitive for a number of years. But yeah, I do think they are going to survive. I guess that's the short version. I think it's a friendlier environment. Monday morning quarterback thoughts on VRSN Berkshire buying. Yeah, it's okay. This is another one, not a huge growth story. I think trudging along at about the rate of GDP growth, about 4%, and decent free cash flow. So yeah, this is fine. Does it really excite me? Wasn't on my short list, but this does create a backstop. I mean, they've got 14% of the company right now, picked up almost 500,000 shares. It does meet some of my requirements, which is outside of those sort of coloring outside of the lines is what I would describe Albertsons as, because I usually am interested in companies that are growing at least as fast as the economy. VRSN is. So yeah, it's fine. This does create a backstop to have them in their buying, and of course it does tend to draw in other potential players. That said, it's trading right now. So let's just take a look. So we'll just go to what they're expected to do. Let's look at full year 2025 numbers. So we'll call it 211 at 866. So 24.4 times forward. Slight discount to the S&P and 8% year-on-year EPS growth. And what are we looking at? 4.4% free cash flow yield. Yeah, all right. I can get behind that. I mean, it's not, beating that sort of core set of numbers I'm usually looking at, but it's beating them by a little bit. So yeah, okay. VRSN's fine. It's not hugely exciting, but fine. You're getting S&P like growth and numbers for less than an S&P multiple, which you should, by the way, because the S&P has the benefit of diversification, which single stocks don't. So usually you're looking for a little bit more cushion than that. But the folks at Berkshire are doing a lot of homework on it, so I assume that they're being thoughtful about it. Steve Garcia, I think duration bonds, I'm assuming you're saying long duration. So high duration bonds have sold off for the time being for a trade, not investment, considering buying TLT July 90 calls or TLT July 88.93 call spread. Good, bad, avoid completely. Well, yeah, I would much rather that you did this using options. So first of all, a couple things are going to keep that cheap. This is a trade. So if it's a trade, it's on a price basis that you're thinking about that. Bonds have low volatility. Where's my options play so I can bring this up? So absolutely the way to play it. This is probably a better question for my friend and colleague Carter Worth, because this is going to be more of a technical question about where you happen to think long rates are. But let's compare the two trades that you were contemplating, July 90s or the July 88.93 call spread. So we're going to put that in here. July 90s. And we're going to see that this is actually a relatively low percentage of the current price of the underlying. And then we're going to put that spread in here. And you were also looking at July, and you're looking at the 88.93. All right. So, oh, did I not take that out to, sorry. There we are. Okay. So there's July. Your break even is going to be at 89.75. So, up less than $3 from where we are right now. And, to put things in perspective, it was there only 3 weeks ago. So that's fine. The only downside there, when you get these longer dated call spreads, is that, they don't, obviously, if you have a really big move, they don't monetize quite as handily as an outright would. But you are spending less money for it. So you could actually, if you wanted to commit twice the capital, twice as many contracts, you could. Probably like the call spread a little bit better for that reason. And also, what are we really expecting is going to happen? So let's see. This is right about the first week of December. Let's take a look at the long rate here. And TLT, by the way, is actually longer dated than the 10-year. So we're talking about 20 plus year. I should probably put that in there, but we'll just look. Everybody likes to look at the 10-year, so why not? So what you're talking about is that you're basically betting that you're going to get those rates back down around 4.2 in the 10s, right? So that's a 40 basis point swing to the downside. And, a couple of things are pointing. First of all, take a look at what's going on with like the Chinese long bond. Those rates are just falling off a cliff. That's the first thing I would say. And it speaks to, speaks to some material weakness there. I actually think that they're going to try to produce, really pump goods on the market. So people are talking about this tariff thing turning into a really inflationary situation. I don't think China can really afford that. They're having a little bit of a credit crisis of their own right now, taking on a lot of debt, and you can see by watching their interest rates what's going on. Things are very unhealthy there. So could this happen? Sure. And, going out to July, you're giving yourself plenty of time. I think either of those trades actually is fine. If your bet is that you're going to get the 10-year back down to 4.2. And just as a reminder, as I was saying, it's really a longer, it's really these rates that the TLT represents, because it's the 20-plus year Treasury. So, yeah, that was down around 4.4 in the 20s for what it is worth. Okay. Let's see what else we got here. This is interesting. Not that all of your questions aren't interesting, they are, but I'm just sort of jumping around here. Considering a $2,000 bet on Tesla rising by March, looking at the 425-500 call spread, or 4 by the 475-500s, or 1 500 call, all cost $2,000. So long calls are simpler and gain more on quick moves. Exactly, actually, what I was just talking about, which is that when you get further out in time, sometimes those call spreads don't have quite the convexity to them. But let's take a look at this another way. The way we should probably be thinking about it, and probably the way that you are thinking about it, is let's take a look at the delta of the multiple of call spreads that you're talking about versus the outright in various scenarios, and then we can sort of get a sense of it that way. It is absolutely true that if you're looking for a sharp move and you are not exactly sure, you don't have a specific time frame by which you expect that to occur, but at any point in the middle, if a move happens almost immediately, you're almost always better off just with outright options. But that is, that's kind of an oversimplification because, of course, yeah, we always are hoping that what we expect is going to happen in the very short term. The other truth is that your break even is going to get, further and further out of the money in standard deviation terms as time passes. Put differently, if you got a stock that's $400, you think it's going to make it to, call it 460, so up 15%. As time passes, if you bought, say, a 450 call, half the time to expiration has passed. That, if the stock has done nothing, it's an ever larger reach for it to get there. So the trade-off really has to do with time and decay as much as anything else. So you're going to trade off some of that near-term ability to monetize for less decay and, a lower break-even and all of that. But let's think about, right now what we're going to do is we're going to actually model these two up and say, okay, well, what would happen if the move happened near term, but I had spreads instead of the actuals? And we'll think about that in terms of delta. So we're looking at March in this case. Oops, I have to put Tesla in here. The outrights that you were looking at were the 1-500 call. So let's look at that. Whoops, that's not the right stock. So actually I'm going to put all three of these in here and we're going to look at each in turn. Okay, so the first one, we're going to look at get rid of the stock here. We're just going to look at a March regular way 425 500 call spread. And that is indeed $2,135 marked to the mid as of today's close price. So in line with the 2,000 you just talked about. The next trade was 4 of the 475s. So here we're going to buy 475 calls and sell the 500s. But we're doing this 4 times. And sure enough, as you said, pretty close to $2,000. And then the final trade that you proposed was one 500 call. So yeah, so we'll put that in. And delete this. $2,145. Okay, so let's take a look at what the Greeks for this strategy are, right? So on this first one, you're looking at about a 20 delta. Okay, so that's 20 delta. So it goes up $10. You're going to make $200. And nominal gamma. Okay, so this is multiply that by 4, whatever, but it's basically nominal gamma. All right. Now, by contrast, we take a look at this one. All right. So here you have, so the call spreads are going to have, these are further out of the money. So it's going to, the call you're buying is going to have a lower delta and much closer in delta to the one you're selling. But you're buying more of them, right? So what we're finding here is that you're going to get actually a little bit more profit for every dollar. 24 versus 20-ish, right? And on this one, this one's going to have the most immediate delta. But what is interesting is that, yeah, so I think if you're trying to play off of that really quick move, and this thing's chopping around, and actually this is the question that we really should be asking ourselves, right? So when do we go to spreads? One of the reasons you go to spreads is because you think the options are more expensive than they should be. Let's take a look at this. I just heard my desktop is lagging, so you guys may or may not be seeing. So I'm just going to ask producer Jay, what are they seeing right now? Oh, you got options play. Okay. So forgive me for a moment. It seems like that there's a big lag. Let's see what's going on here. Okay, here we go. Yeah, you're seeing my mouse move around even though I'm not moving it, but I just wanted to make sure we were looking at this. And this is what matters. So what you're looking at here in white is the price of 3-month options. Okay? And what you're looking at in orange is the realized 60-day volatility. Now, these two correspond roughly, and the reason they correspond roughly, because you would say, well, isn't 3 months 90 days? That's 90 calendar days versus 60 trading days, right? So it's a good approximation. At the moment, at least, Tesla options buyers are getting a very fair deal because the realized volatility, how much the stock's been moving around, is more than the options have priced. Now, if we go back further in time, I don't know how. Oh, it looks like it's caught up. Okay, so good. If we go back further in time, this 80% implied realized volatility that we've been seeing is definitely unusual, right? So here's a 2-year horizon that we're now looking back in time. And this is where realized volatility is right now. Way above the 2-year average. That is the reason why the options are where they are, right? Because the options markets are saying, well, yes, the stock's much more volatile, and certainly more recently, probably in part because of Elon's alignment with the incoming administration, with incoming President-elect Trump. So the options market is kind of accommodating the fact that realized volatility is high, but it's likely to revert to the mean, which is a lower number. So what is that mean? So we actually have that number handy. So I'm just looking at a 2-year history, and the mean is 58.6. And 3-month implied volatility is 62.7. So very fairly priced, right? So if we just get back to somewhere in the middle here, so the truth is that actually any one of these trades is probably reasonably priced based on that assumption. So you're going to have to ask yourself a quick question, which is, do you think that we're going to revert back to somewhere in the middle here, or do you think we're going back down to this kind of a 40 handle type of a situation? Because if you're going to get down into the sort of early 2024 volatility of Tesla, then those spreads are going to make a lot more sense because it's going to offset some of that decay. And it's going to lower your break even, that 400, 500 in particular. So kind of a little bit pick your poison there. But I will tell you that options are very reasonably priced based on the stock's most recent behavior. Something else I would say, and I've mentioned this before, I've mentioned it in the context of the tech bubble. One of the things we observed was that volatility rose as prices rose in late 99 and into early 2000. Investors were getting anxious. They were getting anxious primarily based on valuation, which is that valuations had really exploded, and that was cause for concern. We are seeing that in some stocks, and Tesla is one of them. Vol is going up. Let me put the price in here, even as the price is also rising. Okay, I understand my desk is this is lagging, but this is going to pop up in 1 second. I'm going to show you here. Normally, there you go. Normally, the expectation is this should. Okay, 2, 3. There you go. All right. So we have the historical volatility in orange and the price of the underlying stock in green. Generally speaking, when things are just trending up, volatility is constant or even in some cases declining. Here we're getting both rising. Not something I like to see, because what it tells me is that there's much higher uncertainty in the investor base generally. So those marginal buyers and sellers are a lot more skittish. And so my expectation is not that the price is going to settle in at this level and we're going to see volatility trend back to 40. I don't expect it to stay at 80, but I don't see it going back to 40 just because the valuations probably are at a point where people are very anxious, and they should be, right? So we're dealing with a company that is $1.3 trillion and is trading 13 times last year's anticipated revenue, which we're going to get soon enough. And you compare that to other companies, and that on the back of, you know, a kind of a weak auto market. I understand completely that's not the company's only thing, but yeah, I would just bear that in mind. Okay. So what else we got here? Yeah, let me see here. I apologize that Tesla trade caught my eye immediately, simply because this is one of those things that has interested me, and I brought this up on more than one occasion. Rising prices, rising volatility, always a little bit of a cautionary tale as far as I'm concerned. So, what do we got here? Unity Software. Let's bring that one up. And did I put that on the screen? Happy January, Mike. Unity Software ticker U has a ton of implied volatility. Sold a covered call, 25 strike on my shares. Should I sell out of the money puts? 2, because I think my shares will get called away on Friday. Okay. So if you wait until your stock gets called away, so first of all, you don't have to let your stock get called away, and you may not want it to, in the event that it's going to create some kind of, I don't know whether this is in a taxable account or not. I don't know what your basis is on the shares. But bear in mind, this is kind of just an important covered call public service announcement. Try to factor in the tax consequences of what you choose to do. If you sell a covered call and the stock gets called away and it doesn't create an adverse taxable event, that's fine. Then you can sell puts and write your way back into the position that way. Also fine. That's, some people call that the wheel strategy. So you own a stock, you sell upside calls. If you get called away, you sell downside puts. You get put the stock, then you sell upside calls, just like that. And that's totally fine. If you sell puts ahead of time because you're anticipating having the stock called away from you, number one, you could sometimes buy back the calls possibly at a loss. And so now you have a taxable loss in your account. Whereas if you sold the calls and have the stock called away from you at a gain, now you have a taxable gain in your account. So again, not providing tax advice, just asking all of you to pay attention to that. Be cognizant of it. Yes, I think it's totally fine, actually, to sell downside puts. I often like the idea of actually selling strangles on a stock position. Leon Cooperman, who runs Omega Advisors, and also at Glenview, they were doing a lot of this years ago. They write calls at levels where they're comfortable having stock called away, and they write puts at prices where they're comfortable having more, taking on more stock of stocks that they like. So a lot of people do that. And if you don't have a completely full position, that's a fine strategy. So I'm on board with that. I would keep my eye on any potential catalysts. As you know, this is something I think it's worth being cautious about. They are going to be participating in this 27th annual Needham Growth Conference, which is on Thursday. Yes. So that's going to be going on in New York, and these things can sometimes, create some movement. So we're thinking about that. But yeah, selling strangles against a core stock position, it's a fine strategy. Only one of them can possibly be in the money. Just be aware that you might possibly double up on your position if you do that, assuming you're trading these things one up. Yeah, so, okay. I think we were talking about AppLovin before, and so the question we have, where did I lose this on the page? Oh, there we are. Mike, I have a Feb 21st collar on AppLovin with a 400 call, 300 strike put, so dead in the middle. Put this on to sell app in 2025. What to consider and when to get rid of the whole thing. One thing you might think about, depending on the volatility of the underlying instrument and where your sort of levels of concern are. One thing to potentially think about would be put spread collars, right? It sounds like you were looking to get rid of it this year, possibly because it had such steep appreciation. Maybe, again, you were looking to defer the taxes on it. But, something you could think about is using a put spread collar, depending on the price and where you think the stock could potentially fall back to. Because this is a high implied volatility name. So let's take a quick peek at what that would look like. And I'll show you what I mean. Yeah, I mean, if you were holding on to the stock and you collared it up because you were concerned about giving back some of those massive gains that it had year-end last year and didn't want to take the tax consequence last year, again, no tax advice and all of that, but it is worth thinking about. So let's see. There we are. There's AppLovin. And you had... it's Feb regs. Okay, so let's take a look. First of all, I'm actually just going to put your whole position in because you have it collared. So you were buying the downside put, you were selling the upside call. Those were the 400s. And let me just double check I've got these strikes right. 300s. Okay, yeah. So you were dead in the middle. All right. So you have this position on. I think it would be at this point because one of the reasons vol got so high was, back in October, I think is when we got October. It was first week of November. Got that huge move to the upside on earnings. So, one thing you could consider is if you had something closer to at the money on this one, and actually you could sell this because this is now, we'll buy something like the 350s. You can see that's almost a zero cost, right? And I don't know that you should it's not likely you're going to get what's the implied move? So the implied move on earnings is 14% right now. So this is another thing you could think about doing is structuring it a little bit more like this. What's your concern? That it gives back a decent chunk of that recent gain. You can adjust these strikes accordingly if you wanted to. But that's something you could certainly consider. And I think that would be that's a fine way to play it. I mean, it would be pretty extraordinary if we got another 50% move off of earnings. But, stranger things have certainly happened. I mean, this has had some big moves. We've looked at, actually, only when they reported back in the first week of 2023 did the stock sort of trade sideways. Other than that, it's been double-digit moves the whole way. But this does give you sort of, exposure to, a decent amount of upside, 15% upside, and avoid the first 15% to the downside. And remember, that's another way to think about this too, right? Is that if you can give yourself exposure to 15% to the upside and not the first 15% on the downside, if it drops 30, you lose 15 to the downside. That's, that might be a reasonable risk reward, right? To think about it that way, right? So it could swing, 30% each way, and you're looking at 15% profit or loss. But if it moves 15%, you're looking at 15% profit and no loss. So that's kind of the way I would like to think about it. If you're going to play it through February earnings, which for those of you who are in AppLovin, Bloomberg estimates is going to take place on Valentine's Day, 14th. Okay. Somebody was in my ear saying there was a question that I had missed that I should get back to. Oh, the hedging. The gamma one, I think. Why would you hedge your gamma on that straddle? Okay, I was talking about a strangle. You're positive gamma and hoping for implied volatility. So what's the purpose of hedging gamma? The purpose of hedging gamma is to eliminate my delta exposure as the underlying price moves. So if implied volatility, think about this. If I'm hedging my gamma, which means that if I get long by $100,000 deltas or short by $100,000 deltas, I trade a commensurate amount of the underlying. Probably should be thinking about it, as maybe slightly bigger chunks than that. But so that's 200, not quite 200, 180 shares of SPY. If vol goes up, hedging my gamma is not going to make any difference, because hedging your gamma doesn't affect your vega. Your vega is how much your position changes as a function of moves in implied volatility. It's also to capture, so gamma is one of the benefits that you get from owning options, right? So if I have a delta neutral position and the market swings down and I'm short $100,000, $200,000 deltas, so I buy $200,000 worth of SPY and get flat, and then the market rallies by a like amount tomorrow, now I'm long 200,000, I can sell my 200,000 and I get flat again. Scalping your gamma by adjusting your deltas each day is one of the ways you recapture the decay that you are spending on the options you bought. The implied volatility dynamic is a separate issue. So that's the reason I would do that. That it is a way for me to offset the theta. What I capture, here's another way to think about it. If I buy an option for 20, the implied vol is 20, and the underlying realizes 20, and I'm hedging it delta neutral the whole time, the market can just go up and down, and my option may not end up in the money, but I will have completely paid for that option because I have bought when the stock was lower and sold when it was higher. That's what gamma scalping or hedging your deltas is all about. That's actually the realized volatility. If I buy an option and the stock goes up and down, up and down, and up, but I do nothing and just wait, it could have actually been a higher volatility than I paid. Maybe it realized 30 or 40, but the stock ended where it started and my option is decayed completely. Whereas if I'm hedging my deltas, I'm getting some of that back. Now, you don't always want to do that because it depends on what your use of options is. If you are doing buy rights, so I buy the underlying stock and I sell an upside call at a level when I'd be happy to sell it. So we were just talking about that example in Unity, right? So you own the stock and you sell an upside call. You're just trying to collect a premium. The sale of the upside call, the ideal circumstance is that the stock you own gravitates to the short strike, so you make as much as you can possibly make, and the call expires worthless, so you collect all the premium. That's the best case, right? And so that is a utility of options, and it's fine. What's another utility? Well, let's use the same stock as an example. Unity. Let's say you don't own the stock, but you're speculating that it's going to go higher. So you buy a call, and the stock rallies. Okay, so let's actually put this in here, and we can actually see, because we know this actually did happen. And I'll expand this window. Is it coming up? Okay. So it's mid-late November. Unity is trading $18, so you buy an upside call hoping that it's going to rally, and it does. So you don't hedge that because the whole purpose for buying that call wasn't vol. It was to make a directional bet to the upside. You are making a bet on delta. But if you're making a bet on volatility, that's when you want to hedge, right? So if you're betting that volatility is going to rise, you don't know which direction the underlying is going to go. There's two things that you want to have happen. One, you want realized volatility to actually go up. And the way you make money on realized volatility is by hedging your deltas. So every day I get to a certain point and I hedge my deltas. If I'm long deltas, I sell them until I'm flat. If I'm short deltas, I buy them until I'm flat. The other way you're going to make money making your volatility bet is if implied volatility rises. Then the value of those actual options is going to go up. So maybe I paid $10 for a strangle, and vol goes up, it spikes, and now my strangle, irrespective of what the underlying has done, is now $15. And this is a really important thing to think about. Why are you trading options? Are you trading options to collect the premium, like in a buy right situation? Are you trading options to hedge? So I own stocks and I buy some puts as a measure of downside protection. Or am I trading them based on my expectations of vol? If it's vol, that's when you're hedging. You're going to hedge your deltas because you're trying not to make a directional bet. You're trying to make a volatility bet. So that's the important distinction, right? You hedge your deltas when you don't want deltas. If you're only betting on volatility, it's a pure volatility play, you hedge it. And I actually combine them because I have the core underlying stocks, and then I tend to hedge by buying strangles and hedging the strangles. The idea being that if things really get woolly, implied vol will rise, and I'll probably make some money on the deltas, and then I can take the whole thing off and basically wait and do a reset. So I hope that helps. It has been an hour and 10 minutes. So Michael Anthony says, what did you find on MFA over the weekend? So we actually talked about that, so you must have joined us a little bit late. What I found was, and I encourage you to do this if you haven't done it yourself, so they put a lot of their investor presentations on. They did a presentation in November. It's on their investor relations website. In it, they mentioned that the average coupon on the debt that they acquired in Q3 was 9.4%, which struck me as high. Remember, when we looked at this last week, I like financials when they're trading at a discount to tangible book. MFA is trading at a discount to tangible book. I like REITs as a core constituent of a portfolio in this environment, especially now that they have some yield. It is that. The only thing that concerned me was those coupons, but I had an opportunity to talk to somebody in the private lending space, private credit space, about something called hard money loans. They are doing loans, MFA, I should say, is doing loans on, for example, house flipping. And, what I learned about that was pretty favorable. So the short version is I like it. Hope that helps, but you can go back and watch what we talked about earlier. Sorry, Jay, were you saying something? Because I got something else in my ear. Okay. So that was that. We're going to wrap this up pretty quickly here because I know I'm keeping you guys pretty long. JOB has zero debt with $20.8 million in cash. Buying another business in Atlanta, Georgia. This is G Group. Not familiar with the company. It's a kind of a micro cap. It's a $30 million business. I don't mind you guys asking questions about it, but and I'm happy to look at it when I have free time. I will, if you haven't figured this out, I tend to focus on the Russell 1000 names. So when they're not in the Russell, the chances that I've looked at it, very, very slim. I mean, you may have seen I was looking at Quote Medias for a completely unrelated reason. I'll take a look at it, and maybe I'll have something to say. It's not, may take a look at it, but it's kind of outside of my wheelhouse, I will say. So anyway, thank all of you for joining me today. I started off by talking about Albertsons. These are the kinds of names I would normally say, kind of a value trap, but this is an interesting one because 7.4% free cash flow yield, trading at a single-digit earnings multiple. The deal just fell through, and they're going to be announcing earnings this week. And if management has got their head screwed on right, they're probably going to announce some strategic initiatives to try to solve things now that that deal fell through, thanks to the administration's efforts to put the kibosh on it. I think it's an interesting play. MFA, question we got last week. I like that one. I like VICI also in the REIT space. And I look forward to seeing you guys all back here on Wednesday at 4:15 when we do the next live stream. And I look forward to that. Thanks for watching.